Hello everybody. Today's short webinar is about portfolio rebalancing. So what is rebalancing? Rebalancing brings your portfolio back to your original desired asset allocation percentages to keep true to your original investment diversification goals. So what are the results of rebalancing? Well, our asset classes are rebalanced periodically to capture gains of the winning indexes and to buy the laggard indexes at lower prices. In other words, we want to buy low and sell high over time to maintain the original portfolio allocations. Now, for traditional investment portfolios, rebalancing usually occurs either annually or quarterly, and sometimes even after major market changes. Now, this is the chart that I referred to in the email, and I could spend an hour on this. I love talking about this kind of stuff, but I think you'll find it interesting at least for the next couple of minutes. This is an asset class return chart. Many of my investment clients who've been with me since the mid-90s and late 90s will remember me using a chart similar to this, of course, different years back then, but showing how asset classes over time perform differently and how we can diversify, number one, and use asset allocation and rebalancing to improve our returns over time. So this chart goes back from 2000 to halfway through 2014. Now there's more than 8 asset classes out there. This chart only shows 8, but the point is going to be the same, the educational point. Why they don't use more than 8, I don't know. Maybe they don't have room. But in any case, you'll see that all the assets are color-coded. So the REITs or real estate investment trusts are in red, high-grade bond in green, cash in yellow, small cap in blue, high-yield bond in gray, large cap stocks, which are the S&P 500 in brown, international stocks in blue, darker blue, and the emerging market stocks in purple. Now those are stocks from China, Russia, India, Brazil, countries like that. So they're ranked top to bottom, so the best performing asset class that year is at the top and the worst is at the bottom. Now, a lot of years like 2003, 4, 5, and 6, all the asset classes have positive returns. Years like 2008, only 2 of them had a positive return, and 5% isn't great, but it's a lot better than losing 53%. So let's look at how we would use rebalancing in a portfolio that we had 8 asset classes and we equally weighted them in a portfolio. So if we divide 8 into 100%, each asset class then would have 12.5%. So let's start with 2006, for example. If we started the year 2006 and all 8 asset classes had 12.5% weighting, some are, of course, going to outperform and some are going to underperform. So the real estate investment trusts, emerging markets, and international stocks, and even small caps really outperformed. So at the end of the year, they may be a weighting of 14, 15, 16, maybe even 17% of the portfolio, where the asset classes that didn't do so well, they may be weighted at 8 or 9 or 10%. And at the end of 2006, we want to rebalance, get everything back to the original, in this case, 12.5%. So we would be selling some of our REITs, getting it back to 12.5, selling some of our emerging market and international stocks and small stocks, getting everything back to 12. Of course, we'd be selling high here, and we'd be buying these laggard indexes at lower prices, bringing them up to a 12.5% again. So let's look at what happened in 2007. Well, we sold high the REITs. Look what happened. They were the worst performers in the end of 2007. So it was nice to sell high because that asset class dropped a little bit. But look what happens to emerging market and international stock. You say, well, Mark, why did you sell? Because they had another good year. Well, we didn't sell them out completely. Remember, we just brought it back to 12.5%. So we still did get the benefit of those gains that year. But we never know what's going to happen. But bringing our portfolio back to the original asset allocation goals over time works to our benefit. So at the end of 2007, we would be selling the emerging market and international stocks high, buying the ones that didn't do so well low. And look what happens in 2008. Well, of course, 2008 was an awful year and virtually everything went down. But here are two best performers. In fact, they've done very well over the last 3 years, but they ended up being the worst performers in 2008. So in 2008, we're going to sell some of, at the end of 2008, we're going to sell some of our good performing and our cash, bringing that back down to 12.5%, our equally weighted portfolio. And we're going to be buying the things that didn't do very well at all. In fact, they were awful at much, much lower prices, bringing them again up to 12.5% of the portfolio. And look what happens. We have our real estate investment trusts, our international stocks, emerging market. These three asset classes ended up being 3 of the top 4 in 2009. And we're going to repeat that process over and over again. We're going to sell high and buy low over time to put our portfolio back to the original allocation percentages that we set up originally, and taking advantage of prices when they're good by selling and buying when things are on sale because they have lagged. So that's how portfolio rebalancing works to improve your portfolio results over time. Well, my name's Mark Orr. I hope you've got something out of this and enjoyed that chart. If you want to look at it again with me, that would be great. But in any case, I hope you enjoyed this short webinar. So thanks so much and have a great day.